The stock market. Yeah, it can feel like this super intimidating world, right? Full of complicated charts and numbers flying all over the place. But what if I told you it's all built on a really simple idea from hundreds of years ago? Let's break it all down. So, how in the world do you get from 17th century sailors trading spices on these incredibly dangerous voyages to the stock ticker you see on your phone today? Well, the answer is pretty much everything. The DNA of our modern market, it was literally born on those old wooden ships.
To really get how the market works today, we gotta jump in a time machine and go way back to the very beginning.
Okay, picture this. It's the 1600s. The Dutch East India Company is basically the Amazon of its time. We're talking hundreds of ships sailing all over the world, trading everything from gold to spices. But, as you can imagine, an operation like that, it cost a staggering amount of money.
And that was their big problem. See, every single voyage was this huge, expensive gamble. A ship might sink in a storm, or it could come back loaded with treasure. So how could they possibly afford these epic trips without going broke? They needed a totally new idea.
And their solution was honestly brilliant. They went to regular people and said, hey, help us pay for a voyage. If the ship comes back with a ton of valuable stuff, you'll get a share of the profits. This was a game changer. It spread out the risk and the potential reward. I mean, this is basically the granddaddy of what we now call portfolio diversification.
And just like that, by selling these little pieces of their company in coffee houses and down by the docks, the Dutch East India Company, probably without even realizing it, invented the world's very first stock market. The company got the money it needed, and everyday investors got a shot at making a profit right there with them.
So how does that 400-year-old idea work today? Let's fast forward and use an example that's maybe a little easier to relate to than a fleet of trading ships.
Let's imagine there's a small coffee company that's doing really, really well, but they want to get bigger. Open new shops, hire more baristas, maybe even create a new signature blend. To do all that, they need cash, just like those Dutch traders. So they decide to go public with something called an initial public offering, or IPO. You can kind of think of it like a big debut party. First, they pitch their business to big professional investors. If those investors are into it, they'll sponsor the company's launch onto the public market, and that opens the door for anyone, you, me, anyone, to invest.
Those little pieces of the company that you can buy, those are called stocks. And this is the most important part to remember. A stock isn't just a number on a screen. It's actual partial ownership. When you buy a stock in our coffee company, you literally own a tiny slice of that business.
Okay, so you own a stock, but what makes its price go up and down all day? Well, it all boils down to this constant balancing act, a seesaw, really, between supply and demand. It's a pretty simple mechanic, but it's incredibly powerful. If our coffee company is crushing it and everybody wants in on the action, demand for its stock goes way up, and that pushes the price up. The people who got in early, they see the value of their shares grow. But if the company starts to struggle and more people want to sell than buy, well, demand drops and the price goes down with it, shrinking the company's total value. So what makes people suddenly want to sell? Oh, it could be anything. Maybe some investors get a feeling that the company's value is about to drop and they want to sell and lock in their profit before it does. Or, maybe they just need the money to buy a car or pay tuition. Whatever the reason, when there are more sellers than buyers, that seesaw tips down. But here's the thing, it's not just about profit and loss. The market is run by human beings. And that brings in this wild, totally unpredictable element, our feelings. This is where things get really interesting. It's all about perception. If a company just seems like it's in trouble, that feeling alone can become a self-fulfilling prophecy. Why? Because nervous investors start selling their shares, which pushes the price down, which causes the company to lose actual value. It's this feedback loop driven purely by emotion. And then you have all the other market noise, all the stuff a company can't really control. The government could announce a new trade policy. The price of coffee beans could suddenly double. The company could get some bad press, or maybe a really important executive quits. All of these things create this constant buzz of uncertainty. At the end of the day, our collective confidence or our collective fear is one of the most powerful forces in the entire economy. It can trigger massive booms or devastating crises. And because it's so hard to track, that's why you always hear experts say you shouldn't try to get rich quick, and that slow, steady, long-term investing is usually the smarter way to go. Okay, so that old system of guys shouting in coffee houses, it's been totally revolutionized by technology. And that has made the market more available to us than at any other time in history. For centuries, the stock market really did feel like this exclusive club for only the rich and powerful. But that's just not the world we live in anymore. Not at all.
The internet completely changed the game. It blew the doors wide open. Now, right from your laptop or your phone, you can do your research and buy stocks with a lot of the same tools that the big shot investors on Wall Street use.
By learning how this whole system works, we can actually put our money into companies we believe in, be a part of their success story, and, work towards our own financial goals. The system is more open than it has ever been.
So I guess that brings us to the big question, doesn't it? Now that you see how it all works, from those 17th century spice traders to a neighborhood coffee shop, it really does all come back to that one simple idea of belief and investment. So what businesses do you believe in?